It's time to ask Dad about mortgages. Dad, what's a mortgage?
Mortgage is a loan
Okay.
that is secured by a piece of real estate for the most part. In popular, secured. So what that means is when you take a loan, the real estate is the collateral, meaning if you don't pay the mortgage within the time, if you default on the mortgage, the bank or the person who owns the other side of the mortgage has the right to take that property. So a mortgage is an important instrument to stay current with, and it's not like repossessing a car. It's repossessing your house if you don't pay it.
Yeah. When you pay a mortgage, you are paying a bank, or because a mortgage is on a house, right? So that is the monthly payment you make to stay in the house.
Yes.
So when a house gets sold, you're not paying that to the person who sells it, you're paying it to the bank.
Correct. The person who sells it gets the money from both the bank and your down payment. And that's how they get their cash for the house. They get the combination of those two items when you close on the house.
So interesting.
Okay. So the bank, if you take a $300,000 mortgage and you put down $100,000 on a house, the bank puts a check for $300,000 up at that time of closing, and you put up the $100,000, and me, the buyer, I get $400,000 cash. That's how the house transfers. Nobody sells a house without getting cash.
This is so crazy.
Okay. But now you have a $300,000 mortgage. So you have to make the monthly payments on that. And it is a mortgage, so to speak, because it is secured, meaning collateralized, or the loan is protected for the person who makes the loan by that interest in the house. So you don't own the house outright. If you had put down $400,000 cash yourself,
and you paid that to the seller.
If you had paid that to the seller, you would own the house, what we call outright. But because you didn't, the bank holds the mortgage, and if you don't pay it, the bank can, quote unquote, foreclose, meaning take back the house. Okay. Then they're going to sell the house, and you would get anything they sell it for over the amount of the remaining mortgage at that point. But if they sell it for 50% less than what you put into it, you might get back only 50% of your equity. Or if they sell it for only the amount of the mortgage, you would get nothing. You have no house and no down payment.
The amount of your mortgage that you have paid thus far is the equity that you've put in.
Correct.
Okay.
Well, no, it's your down payment plus the amount of the principal of the mortgage that has been paid off so far.
Which we talked about in our video on APR. So if you're confused about that, just check that video out and you'll...
The principal is the beginning amount of the loan less whatever you've paid in principal payments during the course of the loan so far.
Okay.
So your down payment, any growth in the equity since you bought the house, plus the principal paid off on the mortgage is your equity in the house at that point.
That's so interesting. So even if you're a homeowner, the bank might still own your house. It's good to know. Well, this enlightened some things for me on a mortgage. I really didn't know that about the bank.
Like, comment, and subscribe if you're happy with what you see here. Thanks.
And keep asking Dad.